In 1899, the federal government completed a building in Washington that cost $3.2 million. It featured granite columns, a clock tower rising 315 feet, and vaulted ceilings with hand-carved stone on every arch. That same decade, the government funded 2 transcontinental rail extensions, constructed the Library of Congress, launched a war in the Caribbean, and grew the Navy by more than 50 ships. Across all of it, the income tax collected was zero. The 16th Amendment did not exist. The mechanism that funds the modern federal government had not been invented yet. Something else was paying for everything, and why the documentation remains incomplete is a question the official record has never fully answered. The official story of how the United States government paid for itself before 1913 is a clean one: tariffs on imported goods, excise taxes on alcohol and tobacco, and proceeds from the sale of public land. The textbook version presents a modest federal apparatus, operating within its means, collecting revenue from a narrow set of sources and spending accordingly. It is a tidy explanation that does not survive contact with the expenditure ledgers. Start with the numbers the government itself reported. In 1890, total federal revenue reached approximately $403 million. Customs duties accounted for roughly 55%, while internal excise taxes on alcohol and tobacco contributed another 35%. Land sales, harbor fees, and miscellaneous receipts covered the balance. By 1900, total revenue had grown to $567 million, driven by expanding trade volumes. By 1910, it reached $676 million. On paper, this looks like a solvent institution managing modest growth across 2 decades. However, the spending side does not match. In 1890, federal expenditures totaled $318 million. By 1900, they had reached $521 million. And by 1910, they stood at $694 million. The gap between reported revenue and documented spending widened across the period in ways that efficiency and economic growth do not fully close. The arithmetic stops cooperating long before it resolves. Consider what those expenditures were actually purchasing. The USS Indiana, commissioned in 1893, cost $3.2 million. The Library of Congress, completed in 1897, required $6.3 million across its construction period. The Pension Building in Washington, finished in 1887, cost $886,000. Custom houses in Boston, New Orleans, and San Francisco were rebuilt during the 1990s at costs ranging from $900,000 to $2.4 million each. Post offices in towns of only 4,000 people were constructed from imported granite with bronze hardware and marble interior floors. This was not a government constrained by limited revenue spending carefully within its means. The scale and material quality of what was built exceeds what the official revenue figures can plausibly explain. Gold reserve figures compound the problem. In 1890, the Treasury held approximately $190 million in gold backing the currency. By 1900, despite funding the Spanish-American War and expanding the Navy from 42 ships to 95, those reserves had grown to $602 million. By 1910, they stood at $1.5 billion. The standard explanation credits increased international trade generating larger gold inflows through export surpluses, but tariff revenue across that same period grew by approximately $100 million, not $1.3 billion. The gold that accumulated in Treasury vaults between 1890 and 1910 arrived through channels the public revenue reports do not account for in detail. The buildings are still standing. The granite, the marble floors, the bronze fixtures, and the carved stone detailing are all still present, physical and durable. They were constructed by a government the textbooks describe as small, but the ledgers describe as something else entirely. The gap between what was collected and what was spent is not a rounding error. It accumulates into a number that requires an explanation. The first person to describe the other ledgers was not a politician or an economist, but a clerk. Mary Howland was hired by the United States Customs House in Boston in 1893 and worked there until 1929. In a 1940 oral history interview, she noted that the customs ledgers she maintained were only one set of records. There were other columns, she said, kept separately, and she had been instructed early in her tenure not to discuss their sourcing with outside parties. She knew figures moved in and out through a different office, but when she asked a supervisor what category they fell under, she was told they were special appropriations, and that was the designation sufficient. Thomas Greer, an accountant for the Treasury Department from 1997 to 1926, shared a similar story. He described reviewing quarterly expenditure summaries and noticing line items that corresponded to no custom collection he could trace. He estimated these appeared across reports from at least a dozen regional offices and represented a meaningful share of total federal spending. When he brought the discrepancy to his supervisor, he was told the funds derived from asset management activities administered through the Office of the Secretary of the Interior and were not part of standard Treasury appropriations. He never located documentation for those funds, nor a public report that listed them by source. Samuel Birch, who administered a federal land office in Denver from 1885 to 1921, described mining companies operating on federal land submitting quarterly royalty payments directly to the land office. These were forwarded to Washington through channels distinct from standard revenue reporting. He estimated payments from Colorado operations alone totaled several million annually, but the accounting was handled through different books. He said those reports should be in the archives, but they are not there. 3 federal offices, 3 cities, and 3 people who never corresponded described the same structure: revenue moving through the federal system under categories that were either not publicly reported or reported in terms broad enough to resist outside examination. Albert Cranston, a Treasury official who testified before the Aldrich Commission in 1910, attempted to quantify these non-tariff revenue streams. He calculated they generated between $15 and $20 million annually across the 1890s through mineral rights, harbor fees, and lease payments from railroad companies. While substantial, this was still nowhere near sufficient to explain the $900 million increase in gold reserves. The mystery deepens when looking at the World's Fairs. The 1893 World's Columbian Exposition in Chicago featured a government building that covered 420,000 square feet with a central dome measuring 120 feet in diameter. It was built for $400,000 in 18 months and demolished shortly after. In comparison, the Washington Monument took 36 years to complete and cost $1.2 million. The pattern repeated at expositions in Buffalo, St. Louis, and Virginia. Large, neoclassical structures built quickly and demolished entirely, with funding appearing in the appropriations record without detailed sourcing. The Aldrich Commission noticed these discrepancies in 1910. Its final report identified approximately $340 million in expenditures categorized as internal improvements that lacked itemized sourcing. The report recommended further investigation, but none occurred. 2 years later, the 16th Amendment was ratified, and in 1913, the income tax and the Federal Reserve were established. The timing suggests a massive structural replacement. Then, the records began to disappear. In 1921, a fire in the Treasury Department Annex destroyed internal revenue collection records from 1890 to 1910. In 1924, the Office of the Secretary of the Interior determined that land management records predating 1913 were unreliable and a significant portion were discarded. By 1933, the Treasury consolidated its ledger classifications, and special appropriations simply became miscellaneous receipts, effectively erasing the trail of how a nation once built itself without a single paycheck being taxed.